Hi friends, Simit here from informedtrades.com. In this video, I want to take a look at 5 rules for Forex success that were put forth by Kathy Lean in the book authored by her and by Kathy and Boris Schlossberg of bkforex.com. That book is High Probability Trading Setups for the Currency Market. There are about 10 rules, 10 very important rules that Kathy and Boris swear by that are recommended in that book. We'll review 5 of them that I thought were especially worth highlighting in this video today. The first rule, a more common one, you may have heard some other traders recommend it as well, is to never risk more than 2% per trade. And the reason for this is that if you sustain a larger drawdown, the amount of the capital base you have remaining that you need to, the amount of increase you need to get back to break even it becomes very large. So for instance, if you are down 25%, if you go from $10,000 to $7,500 or $100,000 to $75,000 or something like that, then you now need a 33% gain after you take off that 25% just to get back to break even. So basically, if you're at 100,000, you lose 25%, that puts you at 75,000. You now need a 33% return on that 75,000 just to get back to break even at 100,000. And it gets, obviously if you're down 90%, if you go from 100,000 to 10,000, now you need 1,000% return. So, and then once you're dealing with these types of huge returns that are needed, you then need to take a huge risk relative to your capital base, or it's going to take you forever to get back. So that is why making sure that your drawdown doesn't get that big is vital. So if you can keep it above 25%, 20%, above 10%, a lot of it depends on your own personal risk tolerance, but 2% is the guideline that Boris and Kathy put forth in their book. Another rule is that they trigger fundamentally but enter and exit technically. So here on the screen right now is a chart of the British pound Australian dollar. There is a lot of ways, this video is being made at the end of March 2013. There are a lot of ways or a lot of reasons where people are bearish on the pound relative to the Australian dollar. One classic fundamental reason is the carry trade. Australian dollar offers a higher overnight interest rate than the British pound. British pound also has a higher debt to GDP ratio. So there are many fundamental reasons you could argue that the British pound is a weak currency and the Australian dollar is a strong currency, and that it should fall relative to the Australian dollar. So if that's your viewpoint, or at least according to the method put forth by Boris and Kathy, you have a viewpoint that's established based on fundamentals. When you actually enter and exit is based on technicals. So here, just as an example, obviously technical analysis and fundamental analysis, there's a lot of subjectivity involved in it. There's a lot of different ways of looking at it. But just as an example, here we see what could be signs of a distribution pattern. The market has rallied. We start to see the emergence of some range-bound movement. Here's a classic reversal candlestick. This could be interpreted as a bit of a bearish checkmate. So you now have some signs that a reversal could be coming. Here's where you enter, and in terms of when you exit, it depends on your strategy. You could pyramid or ride the trend all the way down until you see a reversal sign. Some might choose a reversal here, another reversal here, partially exit, lots of different ways to play that. But that's the basic idea. Trigger fundamentally, enter and exit technically. Related to that is sell the weak, buy the strong. So currency, carry trade is a classic example of this. Currencies that are weak, that are characterized by debt problems, that have low overnight interest rates, versus currencies that are relatively strong, where the central bank is genuinely pursuing a strong currency policy. That's sort of the environment you want. So looking for currencies that are weak, asking yourself what's a weak currency, asking yourself what's a strong currency, and then simply short the weak one, buy the strong one. Know the difference, rule number 4, know the difference between scaling and adding to losers. So the main difference is that when you're scaling properly as a professional serious trader, you know the maximum amount of loss you're going to take. So here's an example of one type of scaling. You see the market here falls to a support level after a big crash. So let's say, based on your analysis, that you like to enter. You want to enter at this support level. Now you see this big candle here, you see another support level here, so you might try entering on this candle right here. but you might also place an entry order in case the market pulls back further. However, in this scenario, you still want to have a stop level defined that ultimately establishes when you're going to be totally out of this trade. So in this example here, you might enter at this support level, you might put an entry order in case the market dips further back to where this candle was, and you might place that entry order here. But you've ultimately got to stop below that, somewhere here, or wherever your analysis determines. But you definitely want that to establish a maximum loss you're going to take. What people do with adding to losers, which can often be a very, very bad mistake, is that they don't have a stop in. They don't really have a strategy for how much of a maximum loss they're going to allow. And so the market keeps going against it and they keep adding. At some point, you need to determine what's your maximum loss, and that's really the difference between scaling intelligently and simply adding to losers. Of course, the other form of scaling is adding to winners, as it that's known as pyramiding, and we have a bunch of that information on that on informed trades. Whereas the market moves in your favor, you add. But of course, you can also wait for additional pullbacks so long as you have your maximum loss established. The fifth rule: risk is predetermined, reward is unpredictable. And this is something that's common with a lot of traders who focus on trends, understanding trends. In the case of bkforex.com, their approach, 2008 was a year where the market was really trending, and that's been their best year by far. And that's common with many traders who employ trend following strategies. If they find that huge trend, they'll have huge returns there, and other times the returns will be less, but it's those huge trends that they're playing for. And in that type of environment, if you're pursuing that type of trading strategy, your risk is predetermined, meaning you're still going to know, at what point you're going to get out of the market and take a loss. But the reward is a bit unpredictable. So here, let's say a trader wanted to enter here, they see some support, they see some hammer candlestick patterns, they enter here, they have a stop loss below that. In terms of when they exit, the market starts to trend. They might take some off here, at this resistance level, although we don't really see the market just shoots right through that. They might take some more here, here, all the way up here. It depends, and that's also something that Boris and Kathy talk about in their book of scaling out. So as the market goes in your favor, maybe take some here, and then slowly get out. But basically look to ride as much of the trend as you can. That's often unpredictable. You won't know that at the outset with this type of strategy. A lot of it depends on how the market is behaving and how price is evolving over time. And that's about it. If you have any questions, anything you want to add, join us at informedtrades.com. You can also learn more about Boris and Kathy's trading services and their book that contains all the other rules and trading setups over at bkforex.com. Thanks and best of luck in your trading.